Imagine trying to buy out your biggest competitor, right? You've got the cash, you've got the leverage, but then they literally lock themselves in a basement, fire up a printing press, and churn out 50,000 illegal, completely fake stock certificates just to sell them directly to you. That is exactly what happened to Cornelius Vanderbilt. He dumped $7 million into buying what he thought was an absolute monopoly, only to find out he was buying thin air. This wasn't just a bad trade. This massive betrayal by the Erie board didn't just break the richest man in America. It nearly brought the entire New York Stock Exchange to its knees. The Gilded Age financial markets were, frankly, an absolute battleground. So how did we get here? Let's look at the post-war boom. Between 1866 and 1872, American financial markets morphed into this unbridled, totally unregulated corporate slaughterhouse. You have to remember, the end of the Civil War left the U.S. staring down the barrel of a massive $3 billion deficit. The macro environment was basically gasoline waiting for a match. We're talking about a fractured, dual currency system where gold and paper greenbacks are just battling for dominance. Meanwhile, northern banks, they're completely ignoring a ruined, stagnant southern economy. Instead, they are funneling billions with a B into high-yield, wildly speculative western railroads, 35,000 miles of new track. And with absolutely zero regulatory oversight, Wall Street became this wild playground where ultra-wealthy titans could openly manipulate prices and literally bribe state legislatures. Which brings us to the infinite dilution glitch. Let's zoom in on the Erie Railroad War of 1868. This is where you see exactly how ruthless market speculators like Daniel Drew, Jay Gould, and Jim Fisk weaponized this total lack of regulation. The mechanics of their corporate loophole were, well, they were brilliantly ruthless. Whenever Vanderbilt tried to corner Erie stock, Drew, Gould, and Fisk would just authorize $5 million in convertible bonds, flip them into 50,000 new shares, and dump them straight onto the open market. Every single time Vanderbilt bought, they literally printed stock out of thin air. And get this, when a corrupt judge finally issued warrants for their arrest, they stuffed $7 million in cash into suitcases, fled across the river to a hotel in Jersey City, and guarded themselves with armed thugs. You can't make this stuff up. Look at the visual shock of this July settlement. After successfully bribing the state legislature to legalize their fake shares, yes, they legalized the fraud. Vanderbilt was backed into a corner. To survive the catastrophe, he was forced to buy back those same watered-down shares at a massively inflated $120 just to keep his head above water. But these titans weren't just fighting with legal loopholes. A terrifying technological disruption was about to supercharge all of this manipulation. Enter Thomas Edison. In 1871, he upgrades the original stock ticker into the universal stock printer. This was an absolute game changer for the market. It used double type wheels and screw thread unison to enable real-time nationwide price synchronization. Think about what that means. Suddenly, geographic distance is totally compressed. You don't need physical runners on Wall Street anymore to know a stock's price. And this high-speed data birthed the infamous unregulated bucket shops. For the first time, everyday retail investors could bet on real-time price action without actually owning a single underlying asset. Did this high-speed data make markets safer? No way. It amplified retail mania to a level the world had never even seen before. A sudden crash in New York could now bankrupt a family sitting 1,000 miles away in a matter of seconds. That kind of systemic danger leads us right into the gold market corner of 1869. Having survived Vanderbilt, Gould, and Fisk decided to use their massive new wealth to execute the ultimate insider trading scheme. They were going to hijack the private gold supply. Their goal? Trap every single short seller on Wall Street. And to pull it off, they used President Ulysses S. Grant's own brother-in-law to convince the president to freeze government gold sales. They even slid the assistant treasurer a $10,000 bribe just to get early warnings on policy shifts. By September 22nd, these guys held $60 million in gold contracts. That is nearly triple the actual physical supply of gold available in New York at the time. Then Black Friday hits. Midday, September 24th, 1869, the tension on the trading floor turns into an absolute blood-in-the-streets frenzy. The trap snaps shut and the price of gold skyrockets to an impossible $164. But at that exact minute, boom, word hits the floor that the Treasury announced a sudden $4 million gold dump. The corner broke instantly. The price plummeted straight back down to $130 in just minutes, crushing everyone caught in the middle. So, what is the retail investor impact of all this? We have to look at the real-world fallout, because this billionaire warfare completely eradicated retail capital. Here is the visceral, devastating collateral damage. Broad equities dropped 20% in a single week as over-leveraged traders desperately liquidated everything to cover margin calls. Major clearinghouses, like the Gould Exchange Bank, suspended operations. Respected brokerages defaulted overnight. And even worse, it paralyzed real-world commerce. Chicago wheat prices crashed 50% in a matter of days. Generational savings were just wiped out in an instant. This absolute chaos perfectly defined the bulls versus bears dynamic, the intense psychological war raging on the trading floors of the era. On one side, you had the bulls. They were betting heavily on this endless era of transcontinental expansion, justifying massive, crushing corporate debt loads because they truly believed they were funding an industrial empire. On the flip side, the bears were screaming from the rooftops that this was systemic fraud. They warned of watered stock, unbacked leverage, and a total absence of regulatory oversight. The bears knew Wall Street was effectively running a massive, legally sanctioned Ponzi scheme. And guess what? The final trade proved the bears right. As we push the timeline forward toward the inevitable panic of 1873, the forward market scenarios turn incredibly dark. Smart money started bracing for total railroad debt insolvency. You see, Western rail networks were wildly outpacing actual commercial demand, which was just crushing real corporate earnings. At the exact same time, institutional capital was bracing for a severe legal crackdown on stock watering, especially once the explosive revelations of Tammany Hall's judicial corruption hit the press. The final, undeniable proof that the system was hopelessly rigged was the Crédit Mobilier scandal. Check this out. The actual construction cost for the Union Pacific Railroad was $50 million, but dummy companies, they billed $94 million. The directors systematically looted $44 million in excess fraud right out of the company, leaving public shares practically worthless while they walked away rich. The technology changes, the tickers get faster, and the assets swap names, but the underlying mechanics of human greed, they never change. Whether you are buying watered railroad stock in 1868 or some highly leveraged shares today, the fundamental rule of market manipulation remains exactly the same. The person printing the asset always beats the person chasing the hype. Which leaves us looking at our own portfolios right now. With market valuations expanding and new assets constantly being minted, you really have to ask yourself, are you holding solid fundamentals today, or are you just buying someone else's watered stock? Drop down into the comments and let me know where you think the real vulnerabilities are in today's market.
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.